Welcome to the Fireside Chat on investing in entrepreneurship in the wake of COVID-19.
Elizabeth, you've got an echo. You've got an echo.
Can you guys try muting your lines?
Sure. How do we?
All right, do I have an echo now, or are we okay? Okay, let's try.
Now we can't hear you at all.
Jim, maybe you want to just do the introductions ourselves, maybe?
We can, but I'm getting an echo on myself. So, okay, hang on. Elizabeth, try it now. Elizabeth? Can you hear me?
I can hear you, Jim. You sound good.
Okay, Elizabeth, you want me to just jump in?
Maybe we should just do that. Yeah.
Okay, great. I'm going to jump in. My name is Jim Feuille. I'm the executive director for the Center for Private Equity and Venture Capital at Tuck. I'm also a partner at Crosslink Capital, a venture capital firm in San Francisco. And I'm here with my longtime friend and venture capitalist, Ed Roman. So I'm going to skip my background. You guys can go to LinkedIn and see my background because Ed is the star of the show. And I'm going to let him do his background because I'm going to ask him, I'm going to start with a question that we have in this conference last year. I think 30% of the audience was students. I don't know what it is this year. We have entrepreneurs out there. A lot of people ask about what's the path that different people take to get into venture capital. So Ed, you've had a really interesting path from entrepreneurship to angel investing to angel-less syndicates to being an entrepreneur in residence, and then finally to raising your own venture capital fund, which you just did a couple of months ago. Give us your background, tell us how you kind of navigated this path to get where you are.
Sure, thanks, Jim. So my name is Ed Roman, and I'm based in San Francisco, California. I have a computer science degree from Cornell, so I'm technical. I grew up as a programmer. My first job out of college was I worked at an enterprise software company called Trilogy, and I then essentially wrote a book on programming, on the Java programming language, and started a company off of that, which did training and consulting in the Java programming language. And that company was sold, so I had a small exit for that. Then I created a video game development company that made exercise video games for the Nintendo Wii system. So we helped overweight gamers lose weight and stay in shape by playing online exercise games on the Wii.
You were too early. You should have introduced that product during COVID-19, and
I know
you would have made a lot more money.
It was only a lifestyle business, sadly, probably because of timing. Then I created a marketplace for on-demand developer mentoring. So imagine if a programmer could rescue you from your programming problem in real time through real-time mentoring. So that's what we created. And that was sold to a publicly traded company called Pluralsight, which we then IPO'd that company. So basically my path to venture capital was based on entrepreneurship. And that's the typical path. There's generally two different paths if you're curious about venture capital. One is you can start a company or co-found a company or be an executive at a company and get some experience running companies. And then from there, you'll then have a lot of credibility when you're meeting founders to essentially help them on their journey. Because if you don't have that experience running startups or being a senior leader within a startup, entrepreneurs will sometimes deprioritize you as an investor because you don't have that operational experience that they're looking for. Now, the alternative is you could go straight into finance and get into venture capital that way and skip the operating step. And a lot of people who are successful in VC do this as well. And again, they are a little bit handicapped because they don't have that operational experience. But on the other hand, they make up for that by building a large network of other folks who could help the founders, basically. So that's the two general paths. Now, my particular path was created these three companies. Then I started to advise startups. They came to me for advice. and I wanted to help them. So I gave them advice. And then it's natural for them to ask you as an advisor to then angel invest into those companies. So I started to angel invest, and I made all the mistakes that you could make as an angel investor. We like to joke around in venture capital that the definition of a sophisticated investor is someone who loses money investing. Because like once you've lost some money, then you're quote unquote a seasoned investor. So that's what happened to me, right? So I lost some money angel investing. Didn't realize it. I had bad deal flow back then. I didn't know what I was looking for in a company. And then, over time, you get a little bit better at this. Your deal flow improves. Your acumen at investing improves. You get better at picking. And so I got better deal flow. And then my friends wanted to invest in these companies. And I'm like, all right, let's get these friends to invest too. So we created these things called syndicates, which are groups of investors that invest together into companies. It's almost like we're collecting our checks together to write one big check to make a bigger impact for the startup. And so I did these syndicates for a few years. We did over 100 of these syndicates. And then we used the credibility of the syndicates to then raise these small venture funds. And the venture funds did pretty well. And then we raised a larger venture fund based on the credibility of the small venture funds. So it was very incremental, Jim, to answer your question. It was entrepreneurship leads to advising startups, leads to angel investing and making mistakes, leads to getting your friends to invest together, which then leads to starting small venture funds, which leads to building large venture funds. And not everyone has this path. The more typical path is you join a venture fund as a lower level person, like an associate or an analyst, and then you get promoted up the totem pole from there. That's a little bit more of a risky path for some, because the risk is that you might not get promoted, and oftentimes there aren't that many opportunities for promotion in this job because it's a very small industry. But that's the more stable path that involves less risk from a starting company perspective. So there's lots of different paths again in this industry. There's no one way to do it. The path I took was the path that I took because I just kind of like to just throw myself into the fire, no pun intended, given that we're in a fireside chat right now. So.
Great. So Ed and I met because he was running these AngelList syndicates, and we were a Crosslink. We were looking to increase our deal flow, trying to develop relationships with syndicate leaders on AngelList. We got connected to Ed, and he spent some time with us along the way, a day or two a week as an entrepreneur in residence while he was sourcing his own angel deals, and advised us on deals and sectors that we were looking at. So we worked closely for a long time, and I'm now an investor in Ed's fund and very happy about that. So tell us about Hack VC. Tell us about your fund. How did you define your strategy when you went out to LPs to raise the fund? And how do you differentiate yourself from other micro VCs that have smaller funds, call it in $25 to $50 million funds?
Sure. So we're a very small venture fund. We have a technical approach towards investing, because I'm technical and my venture partners are also technical. So we like to focus on software investments. We like software for a lot of reasons. It's capital efficient. It's high margin. It tends to have recurring revenue, meaning if you sell a customer on a solution, they tend to pay again year after year. We like business to business software, so software that other businesses buy. We like that because businesses can be kind of wasteful and they have big budgets, so they tend to pay a lot for your software. So from a stability perspective, as an investor, if you put your investor hat on, if you sell these big deals to businesses that are paying a lot of money and they're repaying every single year, then that tends to be a stable investment versus a consumer app like Facebook or Instagram. Those can also become very big businesses, but it's a little bit more risky, right? It's harder to tell if those businesses will succeed or fail. They're a little bit less predictable. So that's why we like to focus on that. And some of the weird and different things about us is that we run a virtual conference that's very similar to this AgTech conference. Our conference is for programmers. We run this event called Hack Summit, which now holds the record as the world's largest programmer conference, also a virtual event. We gather together developers from around the world. In total, we've had over 130,000 programmers attend our events. We've been doing it for about 5 years now. And our whole goal for these events is to democratize education. So we want developers from around the world to learn about the craft of software development, to help get them up to speed so that they can educate and up-level their skills, which is, especially in this COVID world, it's very appropriate. A lot of people are losing their jobs due to automation, and then COVID exacerbates that issue. I don't know if you guys know this, but in 1972, the #1 most common job in America was actually farmer in 1972, and secretary was also up there as one of the top jobs. And if you fast forward now about 40 years, it's completely different now. And now the number one most common job is actually truck driver in America, and number two is software developer. Wow. But the truck drivers are actually being threatened right now because the job of a truck driver is going to be slowly displaced through software because of autonomous trucks and autonomous driving, basically. It's not happening yet, right? It'll be another decade or two before the trucks really start to be fully automated because of regulatory concerns. But eventually that'll happen. And the number one most common job is now going to be threatened, right? And farmers, by the way, have shrunk quite a bit as well as a common job. So we think we have a social responsibility for this. Like, as investors, what do we do about this problem, right? Like, we're investing in technology, we're advancing automation, right? We're making money doing that, and you can't really stop the process of innovation. That's a natural part of human evolution. We should embrace that, not resist it. But then what do we do about these displaced jobs? We think a lot about them. So what we do, our little contribution, is that we like to reskill these workers on the craft of software development. We think that software developers are going to be more and more in demand as time progresses. And so we do these virtual events to educate people on software development. And that's kind of like our way of being a socially responsible investor. It also, by the way, helps us to help these companies out that we invest in, because startups are looking to hire engineers, and we can connect the engineers in our audience with the startups. So that helps us make our companies more successful. So it's a win-win approach. So our whole approach to venture capital is, let's pay it forward. Let's build a world based on karma. We're helping the world, and then we're going to make money as a byproduct of doing it.
Great. So I'm going to actually skip the next question I had just because of time. I'm going to jump into COVID-19. It's come up repeatedly through the 3 days of this conference. By the way, just one going backward a little bit, Ed and the Hack Summit were the inspiration for Tuck conceiving of this idea of the virtual Ag Tech Summit, which we did last year for the first time. So Ed was a consulting person to us in helping us build this, which has grown, tripled in size and audience year over year. But let's get to COVID-19. I understand you have some slides to share that talk about the impact of COVID-19 on venture capital investing and how you're approaching it. So let's turn off the fire, launch up your slides, talk about some of these general themes, and then we'll dive into ag tech in particular.
Sounds great. So I'm gonna go ahead and share my screen. Jim, can you see the screen okay?
I can see it, but yeah, there we go. Perfect.
Great. So here's the title slide. There's my email address, by the way, in case anyone has questions. You can just email me afterwards at hack-vc.com. And this is how COVID-19 is impacting venture capital. We already talked about me and my background, right? So we've invested in over 150 startups. We now have several unicorns in our portfolio that are worth over $1 billion. So we've been doing this for a while now. We manage a syndicate of family offices that also invest in venture capital. So these are some of the losing segments, the segments that are challenged right now due to COVID-19. These are segments where, from an investment perspective, we would be a little bit more bearish on these segments. Now, keep in mind that there are always exceptions to these. So some of these segments, there may be companies in these segments that are actually doing well because of COVID. So you should take this with a little bit of grain of salt on a company by company basis. But some of these sectors are very obvious, like transportation, hotels, sports, spas, right? Those are obviously being hit very hard because of COVID, right? Some of the ones that might be less obvious, like luxury goods, things like jewelry, right? Watches. If you're not really leaving the home as often to interact with others, then you might not need to show off as much. So those luxury goods are taking a hit. Obviously, restaurants and bars. Construction projects, there's fewer starts of new construction projects now due to COVID. And social distancing makes it difficult to start a new construction project. But there is still construction happening right now. Some of the construction is mission critical. It has to happen. Online dating is also a challenge sector right now because obviously it's hard to meet other people because of social distancing. A lot of the online dating companies are pivoting now towards video-based dating for that reason. And then, colleges and trade schools, as well as in-person education, is also seeing some challenges right now as well, because it's hard to get students together. Blockchain is also a very interesting sector that's negatively impacted. Blockchain companies generally don't have a business model. They're relying on their tokens to appreciate. So blockchain is one of those sectors that's negatively impacted because they rely on investors to keep their companies afloat rather than their own revenue. And investors are taking a step back right now from investing because of COVID. But here's the good news. There's a bunch of segments that are actually doing well right now because of COVID-19. And so, we believe in every market, whenever there's a catastrophe like this, there's always opportunity that comes out of that catastrophe. So as investors, we're trying to focus on which segments are doing really well. And we'll talk about ag tech a little bit later, but here's some of the other segments that are doing well. So online education, video conferencing, virtual events, remote work technologies like Slack, subscription entertainment like Netflix, HBO, right, Disney, at-home exercise companies, video games, etc., as well as subscription commerce and subscription to food delivery. So there's a bunch of good segments right now, and you can see this in the stock market. Look at the stock prices of Zoom, for example, Slack, or Netflix. Those all reflect the fact that these segments are doing well right now. So, our general overall predictions of this market is that in the venture capital industry, there's going to be a little bit of a downturn right now. A lot of investors are sitting by the sidelines. They're not making a lot of new investments right now in startups. They're trying to wait and see where do the valuations fall, and they're being a little bit tepid to invest. But the venture capital industry will endure COVID-19, and we think it's appropriate to be investing right now, because if you were not investing during previous catastrophes, you would have missed out on a lot of great companies like Amazon, eBay, GitHub, Pinterest, and Slack. Those were all created during financial crises and the dot-com bubble burst. So that's why we think it's appropriate to invest right now. So in general, we're seeing a supply and demand shift. What we're seeing in venture capital is that there are fewer VCs investing. A lot of VCs are focused on keeping their existing struggling companies alive. So for example, look at Lime Bike, Lime, the e-scooter company. They took their scooters off the streets recently, and they have almost no revenue right now. So if you were an investor in Lime, you probably have to provide additional capital to keep that company afloat, which means you have less money to invest in new startup companies and new technologies. So what this is meaning basically is that the valuations are now coming down in venture, and there's fewer companies being invested in because the VCs are now focused on their existing portfolio rather than making new investments. So this means that the bar is now higher to raise capital. There's more due diligence being performed. The valuations are lower. There's more dilution for founders. So those are some of the fallouts of the supply and demand shift. We're also seeing, this is some of the numbers behind how the valuations are changing due to COVID. So the bold row that you see here is what's happening in this post-COVID world. So we're seeing about a 30 to 40% drop in terms of the value that entrepreneurs are getting for their companies when they're raising rounds from VCs due to COVID, again, because of the supply and demand shift that we discussed earlier. And if you look across the board, these are some of the sectors that we think are doing pretty well, both historically as well as going forward. So IT, by the way, has historically been one of the best performing asset classes. It's outperformed financials, healthcare, gold, crude oil, etc. This is all pre-COVID data for how well IT has done. IT, by the way, is essentially software infrastructure, software as a service companies, and many ag tech companies fall into this category. This is more recent data. This data is showing which startups are doing layoffs due to COVID-19. And you can see at the top, you got travel, retail, fitness, real estate. Those sectors are having a large number of layoffs right now. But if you look at the bottom, IT, that's kind of one of the least impacted sectors right now due to COVID-19. So again, B2B software, recurring revenue businesses, software that farmers could buy, for example, to manage their operations better. Those types of sectors are neutral to positive right now because of COVID. So let me just skip ahead to this slide here since we're low on time. This slide is kind of showing you one of the companies that's doing really well right now due to COVID, and that's Crowdcast. And Crowdcast is the technology we're using right now for this virtual event. So this slide is actually a little bit out of date. This slide shows the revenue growth of Crowdcast between February 28th and March 27th. So it's about a month old, this data. But you can see here that they started a hockey stick and grow really fast right when COVID hit, which was in early to mid-March. And I've caught up with the CEO recently, and he's doing even better now. So their revenue has grown to about $2 million in annual revenue since this graph. So it's gotten even better since then. And this kind of falls into what we were talking about before about how, video conferencing, remote education, et cetera, are benefiting from COVID-19. So that's kind of like the broad industry perspective on what's happening with COVID, Jim. Any questions on that?
Yeah. So let's jump into ag tech a little bit. Elizabeth, you can bring back the fire so we can get by the fireside. So, in this conference, we've covered a wide variety of sectors in ag tech. We've talked about alternative proteins. We've talked about food traceability and safety, food waste, e-commerce and marketplaces for ag, fintech for ag, robotics, vertical farming, other cultivation technologies, local and regional supply chains, and then all of this tech, software tech, IoT, Internet of Things, imaging, software, data, artificial intelligence, analytics. So what areas within ag tech, what specific areas do you think will either benefit from COVID-19 or at least not be badly hurt by it? And are there areas you think might get hurt harder?
Mm-hmm. That's a great question, Jim. So I would say broadly at the high level, this is an important question to ask. And the reason why it's such an important question to ask is because, if you're building a startup and you're negatively impacted by COVID-19, then it could be challenging for you to show traction for your company over the next 1 to 2 years, because we don't think there's going to be a V-shaped recovery from COVID-19. We think it's going to be a prolonged recovery, especially due to the psychological impact that COVID-19 has had on consumers and consumer consumption being lower because of COVID-19. So we think that there may be startups that are investable, and over a 10-year period of time, they will do well despite COVID-19. But realistically, if you can't show progress over the next 1 to 2 years, then how are you going to raise the next round of financing? Like, let's say you raise from an investor right now, or you start a company right now. If you can't show that growth curve that gets investors excited, they may not want to invest in your next round, and that introduces financing risk for your startup. So that's why it's such an important question to ask. Now, regarding which sectors are that we're projecting will succeed or fail within ag tech, at the broad level, we think that the type of company that will do really well right now is companies that are saving customers on their costs. So, for example, you put yourself in the shoes of a farmer. You've got a fairly low margin business, right? You've been in this business for most of your life. Food is not a high margin business, so every dollar really counts. And you're in a situation where your profitability as a farmer is being challenged because of COVID-19. For example, one reason for this is because the whole supply chain for getting food from the farm to the customer has been turned upside down because of COVID. Like, as a case study, for example, farmers right now are throwing out a lot of their milk, as well as some of their cheese. Because if you think about it, the way that a business consumes cheese is they buy a barrel of cheese, whereas the way that a consumer buys cheese is they buy maybe slices of cheese. So the way that cheese is packaged for a business and for a restaurant is very different than how cheese is packaged for a consumer. So because of that supply chain issue, farmers are having to actually throw out some of their milk, even though there still is the same number of people in the world that need to be fed. And it's because the end product of the barrel of cheese is in lower demand right now because restaurants are now closed, even though the consumers are still consuming the cheese at home. So that's having a real impact on farmers and their margins, and their profitability is now challenged. And we haven't even talked about the issues around social distancing and how that could impact a farm. So there's lots of challenges farmers are having right now. So one way you could approach this is, are we able to save the farmers on costs? Meaning, if my budget is now smaller because of COVID-19, how do we sell into that value proposition? So instead of our value proposition in the past being, how do we generate revenue for customers? That's something that Wall Street rewarded in spades pre-COVID, because growth is what everyone cared about. Now what people care about more is profitability. How do we become a sustainable business? How do we survive this downturn and emerge from the other side? And the way that a startup can enhance that is to basically say, we're going to save you on costs rather than being a cost center for you to acquire our technology. So a lot of our companies in our portfolio are pivoting their messaging. Whereas before they were emphasizing more on, we're going to add revenue to you, they're saying we're going to reduce your costs. Now within ag tech, food traceability we think is an interesting sector. For safety, there's been a number of examples with COVID outbreaks in meat and poultry processing facilities. So having traceability and safety around that is going to be critical going forward. We think that IoT and data and AI and analytics can also be useful and interesting, especially if you can save farmers on costs. Alternative proteins, the whole beyond meat category, impossible foods. Those sectors we think are going to become more and more interesting because consumers are still very much health sensitive. And with a lot of the crisis happening right now in the meat industries, alternative proteins are a solution for that. And we also think robotics and vertical farming are interesting sectors, but only if you can do it in a capital efficient way. The whole capital expense that you're putting into robotics and vertical farming can be challenging for some investors because it's very dilutive to their investment if they have to raise all this money to pay for all this hardware. So if you can find creative ways to finance that hardware, for example, through loans or through leasing the hardware, et cetera, or have customers prepay for the hardware, those are ways around those problems. So that's kind of how we think about things at the broad level. And we're, by the way, investors in several ag tech companies. Like, I'll give you a couple examples. We're in a company called Cowlar, which is a Fitbit for cows. It'll actually track to see whether a cow is healthy, unhealthy, or the cow is pregnant and can be milked. We're also invested in a company called Shelf Engine. Shelf Engine helps reduce the waste that a restaurant or a retailer has, because if they're over ordering on food, if they're ordering too much food, for example, it helps reduce that cost because the system intelligently helps the restaurant order the proper amount of food. That's saving the restaurant on money. It's saving them on costs, saving them on budgets, keeping them more profitable. That's a good value proposition to have in this environment right now.
Great, excellent. So I think in some of those answers, you've already answered the first audience question. Let me ask you the other one. It's how do you think about the winning versus losing segments in ag tech in the short term and in the long term? And how do you think about investing for the short term and for the long term? Are there current losers who could be winners over the long term, current losers who could be winners of the long term? And how does that impact the way you think about your firm?
Absolutely, yeah. I mean, generally speaking, if let's say you're building a startup that's in a quote unquote losing segment where your company is going to have challenges generating revenue over the next 12 to 24 months, then there's certain measures you could take to help reduce that issue for you. And this is some of the advice that we give to our startups. One thing you could do, for example, is you could have customers prepay for contracts. So instead of the customer paying you once a month, maybe you can convince them to pay all in advance in exchange for a discount, right? Sometimes if a customer is more price sensitive over the long run, if you're a struggling startup, having cash in the door can help you to alleviate your financing burden. Another thing you can do is you can do consulting. So if you're thinking about building a startup company and you're not quite sure about your hypothesis, if you're not yet at product market fit, if you can do paid consulting for your customers, that's actually a way to do paid lead generation. So that way you can actually have the customer help shoulder the risk of you iterating to product market fit. So this is a common pattern that we've seen in companies. In fact, I've seen companies that VCs invest in that really didn't have any business plan other than to do consulting to determine a business plan. Now that doesn't happen very often, right? But it shows you that it's generally a proven path to building a reusable business model that's sustainable over a long period of time, because you're confirming that customers have a problem that you're solving. You're not building technology in a vacuum. You're helping customers through consulting, and you're evolving a product out of that consulting, basically. Another thing you could do is you could tap into debt facilities. This is only for companies that are further along, who have the gravitas to command those debt facilities. That's one way to endure this financial hard time. But in general, the way that we look at the world is that if you're in a subsector that's positively impacted by COVID, you're going to see a tailwind to your growth for the next 12 to 24 months. It's going to enhance your financing. If you are in a neutral category, then business as usual. You might want to consider maybe doing a hiring freeze, maybe doing a few selective layoffs just to keep your burn rate low. That way, you're reducing risk. And then as you start to see progress and milestones, you can then start to increase your burn rate selectively. And if you're in that challenging category where COVID is negatively impacting you, then generally what we're advising startups to do is to kind of obviously rely on customers to help pay for some of their expenses. You can rely on friends and family financing if that's available for you. But you generally want to be pitching investors when you have a strong story to show, where there's a strong business case where investors can see growth in the near term, basically. But in general, when you're building a company, it's over a 5 to 10 year period of time. That's how long it takes for these venture capital exits to happen. And some of the best companies in the world get created in crisis situations. So if you have an idea for a startup and you're thinking about jumping in and doing that, now might be a good time to do it. You just got to be creative about the financing element of it.
And call Ed. You've got his email address, and tell him you were on the summit and you have an idea for him. Ed, it was great advice to end the session. We've got to keep moving on. Next up, we have Dana Worth from Impossible Foods, which is our last session of the summit before we get to concluding remarks from the students. Thanks a lot, and thanks for being here, Ed. Take care.
Thanks, Jim. It's fun.